Why is gold falling even as geopolitical risk flares? The answer sits in real yields breaking multi-month highs and a forced liquidation cascade from over-leveraged macro funds. Today we give you the gold trading strategy that accounts for liquidity grabs below 4,400, the VIX structure leaking into commodities, and the gamma wall that the S&P 500 is fighting. Because gold is moving tick for tick with real rates and risk appetite when gold is dropping, and every retail trader you know is hitting the sell button right now. That is exactly why this level, 4,365, is about to become the most dangerous trap in the entire market. There is one danger zone and one hidden opportunity right now, and I'll show you both. This is not an academic guess. This is the institutional flow, the derivative positioning, and the technical framework that tells me the short side is overcrowded and the bounce, when it comes, will be violent. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow with your risk tightly defined, instant market verdict. The session bias for XAU or USD today is a fading of the breakdown, actively monitoring for a trend reversal off deeply oversold readings. The higher timeframe direction is still strong sell on the daily and weekly, but the monthly picture is a screaming strong buy, and that creates the tension that produces monster moves. Right now I am looking for a reversal to be confirmed, and I will not blindly buy the dip. Write this number down. If we lose 43.65 today, the entire structure resets, and a much deeper liquidation toward 4,200 becomes the base case. Got it? 43.65 is the line. The herd is positioned heavily short, with sentiment indicators showing bearish extremes and put-to-call ratios on gold ETF stretched to levels we only see right before a squeeze. When everyone is already on one side, the risk-reward for continuation collapses. The liquidity pool is below 4,400, and smart money often hunts those stops before the reversal ignites. Now let's walk the charts from the very top down. On the weekly time frame, gold is still inside a corrective sell signal, but price is approaching the 200-week moving average, currently around 4,384, and this is not a level the market treats lightly. The last time gold tested the 200-week MA from above, it sparked a multi-$100 rally. The monthly chart remains a strong buy with a long-term structure of higher lows intact. That tells me this sell-off is a correction within a secular bull market, not the start of a new bear trend. Now we move to the daily. The daily is strong sell, with price accelerating below the MA20 at 45.45, the MA50 at 46.44, and the MA100 at 46.19. That's 3 layers of resistance stacked overhead, but the one moving average that matters most, the 200-day, is sitting at 43.84, and we are magnetically pulling toward it. The daily MACD is deeply negative at -44, which tells you momentum is incredibly bearish, but when you see numbers this extended, the probability of a mean reversion spike rises sharply. Today's price at 44.30 has already sliced through the first key support of 4,444, turning it into near-term resistance. The next 2 support levels are 44.14 and the big one, 43.65, just below the 200-day. That 43.65 to 43.84 zone is the bear trap alley. The RSI on the daily is 37.8, not yet oversold below 30, but the stochastic at 55 is already curling up from depressed levels. That is an early whisper of hidden momentum building. Now here's what most traders miss. Drop down to the 4-hour and the 1-hour. Both are strong sell. The 5-hour is strong sell. The 1-hour is strong sell. Everything looks completely terrible. And that is precisely why the trade works. The lower Bollinger Band has been tagged, and we are seeing a classic compression pattern. On the 4-hour MACD, the histogram is still printing negative bars, but the slope is starting to flatten, and if price holds above 4,400, we will likely get a bullish divergence signal between price and the MACD oscillator. A bullish divergence here, right at the 200-day moving average and inside a major support zone, is a pattern that institutional algorithms are programmed to buy. But retail ignores it because the daily candle still looks red. The cross-asset linkage is critical. Gold is moving tick for tick with real yields collapsing. The 10-year TIPS yield has shot up to multi-month highs, and that's what's been punishing gold. However, yields are now bumping against a structural resistance level, and the dollar index is showing exhaustion signals near the 105.50 area. If DXY rolls over, gold will blast higher because the pressure that created this sell-off begins to reverse. Watch that correlation. Gold is also moving inversely to S&P 500 intraday fear spikes. If equities dump, gold could get dragged lower initially, but then it becomes the safe haven bid. For the next 1 to 2 weeks, my directional lean is a tradable bounce from the 4365 to 4400 region, targeting a move back into the 4523 resistance, with a stretch target of 4572. The event that invalidates this bounce thesis is a daily close below 4365. If that happens, the structure breaks, and we shift to a bearish continuation toward 4200. Right now I want your bias. Do you think the dollar index breaks 105 this week and kills gold further? Comment yes or no below. I'm tracking consensus in real time. Yesterday's news flow didn't drop a singular bombshell headline. Instead, it was a steady drumbeat of hawkish central bank speak and a bond market repricing that acted like death by 1,000 cuts for gold. The phrase gold oversold near lower Bollinger Band circulated on terminals, which tells you the quant funds are now aware of the extreme reading. The analyst community was hitting targets on Tuesday's sell call, and now the headline reads, "Time for a trend reversal." This is not retail hopium. This is the shift that occurs when the smartest macro desks realize the move has overshot the underlying fundamental narrative. The policy divergence story, Fed still relatively hawkish versus other central banks, has driven gold lower, but the market has already priced in a 75 basis point cumulative tightening scenario that is essentially fully digested. Any hint of a data miss or a dovish tweak in minutes, and the pain trade is higher. The 2-year yield is consolidating, and gold is hypersensitive to that. On the positioning front, ETF flows have been bleeding for weeks, which confirms the bearish sentiment, but large speculators are still net long, and the recent liquidation is washing out weak hands. That's the fuel for a rebound, clean positioning. The geopolitical bid hasn't evaporated. It's just been masked by the dollar strength. If you see a sudden escalation or an oil supply shock spike, the safe haven premium will snap back into gold regardless of the dollar. All of this tells me the asymmetry favors a long play from support. Most people skip this trade setup section. That's exactly where the money is made. Keep watching. I'm about to hand you 3 plans with exact numbers you can screenshot and use tomorrow. Strategy number 1, the sniper. This is the conservative, high probability approach. We wait for price to fully test the demand zone between 4385 and 4400, the location of the 200-day moving average. We do not buy blindly. You only enter on a confirmed bullish reversal signal on the 4-hour chart. A bullish engulfing candle that closes back above 4,400, or a 4-hour close with a long lower wick and RSI ticking up from below 35. If that prints, your entry is at 4390. Your stop loss goes at 4358, just beneath the major 4365 support, allowing for a small wick extension. Take profit 1 is set at 4444. The level that was former support and will now act as initial resistance. Take profit 2 sits at 4523, the first major structural resistance cluster. The risk-reward on this trade scales from roughly 1.7 to 1 on the first target, all the way up to 4.2 to 1 if you catch the full extension. What voids this setup entirely? A daily close below 4,365. If you see that, you cancel the order and step aside the sniper, conservative, entry. 4,390, 4H candle close above 4,400 with bullish engulfing, stop loss. 4358 take profit 1, 4444 take profit 2, 4523 risk, reward. 1 minute and 1.7 seconds to 1:4.2 are invalidation. Void if daily close below 4365. Here's what separates amateurs from professionals. After that sniper plan activates, you don't just set and forget. You scale out half at target 1, move your stop to break even, and then let the runner travel to 4523. That's the discipline that turns a small edge into a career. Now type your gold range for tomorrow in the comments right now. I want to see who's aligned with the 43.65 to 44.44 zone. Drop your high and low estimates. Strategy number 2, the active trader. This is for those who want to capture the bounce without waiting for the deepest retest. The setup uses the 4,414 intermediate support as your launchpad. You wait for a 1-hour candle close above 4,430, right near current price, with a bullish follow-through bar that confirms buyers are stepping in. If that triggers, you go long at 44.30. The stop loss is placed at 4,400, just below the 4,414 support, giving you a tight 30-point risk. Take profit 1 is at 4,480, which is a short-term pivot and the area of the falling MA5. Take profit 2 is at 45.23, the same upper resistance. The risk-reward starts at 1.7 to 1 and expands to 3.1 to 1. Once price clears 44.80, trail your stop to the swing low of the previous 1-hour candle to lock in gains and ride the momentum higher. If a 1-hour candle closes below 4,400, you are out immediately. No hesitation. The active trader, standard, entry. 4,430, 1H close above 4,435 with bullish momentum, stop loss. 4,400 take profit 1, 44.80 take profit 2, 45.23 risk, reward. 1 minute and 1.7 seconds to 1:3.1 are invalidation. 1H close below 4,400. This next signal changes everything for aggressive traders. Strategy 3, the aggressor, high risk, high reward, and only for those who can lose small and manage risk with zero emotion. The aggressor does not wait for confirmation. It anticipates the liquidity grab that often happens in the final flush. Here's the play. If gold prints a sudden, sharp spike down to the 43.65 to 43.70 region on a 15-minute chart and immediately rejects, leaving a massive pin bar or a bullish hammer with a long lower wick, you enter at 43.72. The stop loss is razor-thin at 43.59, right below the support. That's only 13 points of risk. Target 1 is a quick scalp back to 4,400. Target 2 is 4,430. The risk-reward ratio is 2.3 to 1 on the first target, and potentially 4.5 to 1 if price rips higher. This trade plays the forced liquidation of weak shorts and the algo-driven mean reversion. The warning: if the 15-minute candle closes below 43.65, you cut the trade with no questions asked. This is not a hold and hope situation. It's a surgical strike to the aggressor, high risk, entry. 4,372, 15M bullish pin bar at 43.70 zone, stop loss. 43.59 take profit 1, 4,400 take profit 2, 44.30 risk, reward. 1 minute and 2.3 seconds to 1:4.5 are invalidation. 15M close below 43.65 ILL. Say this clearly. The aggressor strategy is meant for traders who can size down to a tiny fraction of their capital. The volatility in these last-minute flushes can spike spreads, so you must use a limit order and accept that you may miss the entry. Your survival is paramount. Risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news. Stops are non-negotiable. This is how you survive to trade the next big move. The market will always offer another setup, but if you take away one single number from this entire session, it's 43.65. That is the level that holds everything together for the bullish reversal thesis. As long as gold stays above 43.65 on a closing basis, the structure is a corrective dip within a larger bull trend, and a sharp bounce is the path of least resistance. Tomorrow's wildcard is the next major US data print and the daily close against the 200-day moving average. We are also watching the S&P 500 gamma wall, because an equity sell-off could inject an extra wave of safe haven bids that accelerate gold's recovery. If you want the full breakdown on Bitcoin and the S&P divergence and how it links to this gold setup, that video is live right now. Tap the end screen and continue your preparation. Smash like if this gave you a clear, tradable plan. Subscribe, hit the bell, and I'll see you in the next one, before the next explosive move leaves the station.